I'm Anastasia Moroso here in the iCapital studio. On this all-new episode of Beyond 60/40, we're focusing on structured credit, and I speak with Greg Lippman of LiberMax, who explains why the current market environment is ripe with opportunities for structured products. Then I sit down with iCapital Managing Director and Head of Technology Solutions, John Scarpato, who joins me in the studio to answer your question of the month. And as always, I share the one thing that caught my attention this week in private markets. Take a look. In today's private market poll snapshot, the one thing I'm focused on is this. What could the higher for longer rates mean for the U.S. economy, and are there parts of the credit markets that we should be concerned about? Over the course of April, the U.S. Federal Reserve has notably changed its tune, from expecting several rate cuts in 2024 to now expecting to stay on hold at current level of rates for longer, because they need to gain further confidence that progress on inflation is in fact continuing. Now, the equity markets reacted negatively to this pivot in April. But in our view, the U.S. economy has figured out a way to function with a higher level of rates because the U.S. consumer isn't as indebted as it once was, has most of the liabilities that are fixed rate, and the jobs market is still going strong. Now, this should continue. However, the question we also need to ask is, how will the various non-consumer borrowers cope with higher for longer rates? In our 2024 outlook, we sized up the various categories of debt across the United States economy, specifically focusing on those with large upcoming maturities or high percentage of floating rate exposure. And as you can see in this chart, the U.S. government holds and needs to refinance the largest amount of debt at higher rates, and that is likely to contribute to wider deficits. But let's put the government aside for a moment and focus on the private sector. The next area of concern is the commercial real estate. There's approximately $5.8 trillion of notional debt outstanding in commercial real estate, with 20% that needs to be refinanced this year and next. And a good portion of that debt is also floating rate. With rates remaining elevated, this poses an ongoing concern to CRE debt holders, especially in the office space. Office vacancies rose from 17% during the pandemic to 20% most recently, and not surprisingly, delinquencies have followed. For example, office CMBS delinquencies have reached 6.58%, and that is materially higher than any other sector where you can see those delinquencies do actually remain in check. Now, office debt accounts for 27% or $171 billion of the CMBS market, and the space may continue to see defaults if rates stay elevated. Now, another area of concern that stands out is the rising number of private equity and venture capital portfolio companies that are filing for bankruptcy. And that number has surged to a record high since the global financial crisis. The share of the overall bankruptcies by those private equity and venture capital-backed companies has also grown to a record of about 18%. This poses a risk to those companies' debt holders who either purchase publicly traded leveraged loans or privately held loans. Indeed, there's about $1.3 trillion of leveraged loans outstanding and another $733 billion in private credit, and we have seen those default rates tick up as well for those categories. These risks are worth highlighting and monitoring as the Fed is keeping rates high for longer. But in our assessment, which we had in the beginning of the year and that still stands today, there are definite pockets of stress that will continue to feel the impact of high for longer policy, but they're not systemic enough to derail the overall U.S. economy because they are relatively small in size, and there's a lack of amplifiers which were so dominant during the global financial crisis. Now, from the opportunity side, the dislocations such as repricing in CMBS bonds or CLOs often present opportunities for credit managers who may also like holding consumer asset-backed debt because that makes good sense given the strong economy. Now, that's my one thing in private markets this week. You might recognize my first guest today from 2015 film The Big Short. Greg Lippman is here in the studio, and he was the head of global asset-backed securities trading at Deutsche Bank, where he famously and successfully bet on the collapse of the housing market leading up to the global financial crisis. Today, Greg is the founder and chief investment officer at LiberMax, an asset management firm with $10.2 billion in assets under management. Greg founded the firm LiberMax in 2010, specializing in a broad range of securitized products, including asset-backed securities. So, Greg, welcome. It's so great to see you here today.
Thank you for having me.
It's good to see you. And Greg, I know you've been in this world of securitized products and asset-backed finance for 30 years. So my first question to you is, why structured products? Why structured credit? Why does that belong in a client portfolio, especially in a private wealth client portfolio today?
Sure. Well, first of all, why structured products? Structured products are super important for the financing of Americans, right? If you have a car loan or a mortgage, or you have credit card debt, almost certainly that debt is in some securitization. So without securitizations, it would be harder for Americans to borrow money in general. So it's going to be with us, forever, notwithstanding the changes since the great financial crisis. As it relates to why it should be in a person's portfolio, I think now is a particularly good time for the product for two high-level reasons. One, in the wake of the great financial crisis, which, as people often hear, governments fight the last war, we had a situation where people felt that aggressive lending to consumers packaged into wacky financial products, sold to levered institutions, caused a great financial crisis, right? So the government said, we're not going to ever have this again. We're going to regulate lending. We're going to create things like the Consumer Financial Protection Bureau, and we're going to make it harder for people to borrow money. We're going to have people borrow money fixed rate instead of floating rate more than they ever had before. That's point one. Yeah. Point two, so the fundamentals of the product are much better than they used to be because of these regulations. The capital charges compared to before the great financial crisis are 2.5 to 5 times higher than they were before. And so that means there's permanently less demand for the product. So the product is both fundamentally cheaper than it used to be relative to corporates, and when you combine that with the current and likely continued high interest rates, fixed income, and specifically spread fixed income like structured products, offers a healthy yield in a world where equities are a bit more uncertain, the returns.
Right, and the yield that we're talking about is in the low double digits.
It's highly dependent on each securitization you buy and where you are in the capital structure and the duration and the liquidity, but at a high level, our portfolio yield is in the low double digits.
Right, and when you look at things like high yield bonds, for example, pure high yield bonds, the yield to worst on that is probably now, 8, maybe 9% depending on the month, but clearly yield pickup potential there, and sounds like it's safer or better risk managed securities today versus what they were during the financial crisis. But to go back to the financial crisis, obviously you successfully, as I mentioned, bet against the housing market, and you were essentially betting against these various securities that you're now thinking about buying. So what's changed today? What's the opportunity set for you now in securitized products?
Sure. Lending before the great financial crisis was extremely aggressive. People had high loan-to-value first mortgages. They often had a second mortgage after that. And they had more than half of mortgages in the country were floating rate. So people were very levered and very exposed to interest rate changes. Today, 95% of the mortgages in this country are fixed rate. 66% of Americans own their own home. 80% of the mortgages in America are 5% or lower today. So you have a situation at this time where more than half of Americans are earning more on money markets than they're paying the bank. And when you think about a bank, the whole point of a bank is they pay people less for their deposits than they charge people to borrow. And it's the key reason why we haven't had a recession yet, is because the U.S. consumer is very resilient, and that's an outgrowth of these legislative changes. So I think we were able to create a portfolio that participates in bull markets and has a resiliency between the yields of the portfolio, which enables hedging, and the place in the capital structure and the fundamentals of the loans, that it's going to be resilient in downdrafts.
Right. And when we think about the broad securitized product space, it's about $19 trillion, and some of that includes the ABS, asset-backed securities that you mentioned that are backed by some of those consumer loans. But then there's the corporate side of that, and then there's the commercial real estate side of that. So the commercial mortgage-backed securities, the CLOs. So if you were to think about the risks that are lurking in the economy today, fine, the consumer is resilient. Fine, the consumer can stomach the 5.5% interest rate, but can the leveraged loan issuer, can the commercial real estate operator, can they continue to operate with this level of rates without defaulting?
It's a great question, and I think ultimately when we go into the next recession, and whenever that might be, it's going to be led by the corporate sector. I think the corporates, similar to what happened in 2000, the 2000 to 2002 time was a period where corporates were under a certain amount of a correction after the first internet bubble, and the U.S. economy was pretty resilient. The consumer sector, we had a brief recession in 2001, and equity markets struggled for those 3 years, and structured products markets did fine because at a high level, our product is driven more by unemployment versus other things.
Well, let's expand on that a little bit. So, when we see a jobs report that's stronger than the market expectations, the knee-jerk reaction in the equity markets is to move lower because presumably the Fed is not going to cut rates. But what does a strong labor market mean for your portfolio? And do you see that strength continuing?
All assets are linked at some level. And while there's certainly stocks that go up when most stocks are going down and whatnot, in an environment where the equity market is selling off, there's definitely going to be downward pressure on our long portfolio. But in the long run, we're driven by do people pay their mortgages back or not. In the short run, we're driven by just market sentiment more broadly. And so if unemployment stays low, defaults on these securitizations are going to stay low and they're going to be resilient.
How concerned are you about the risks there? Do you think it's well enough talked about to where it's already in the price, or do you think there's more of a downdraft?
Everybody knows that commercial real estate is a problem, that work from home is going to be a part of reality forever. That's not a secret, and that's in the price. And when you think about it as an investor, it's all about reality versus expectation. So if you think of like some of these tech stocks, if you think they're going to do great, the only way their stock's going to go up is if they do amazing. And certainly some stocks have continued to defy expectations and done better. Yeah. But there's not a lot of room to do better than great. Conversely, people think that commercial real estate, specifically office, is going to be horrible. And if you can buy something to horrible, the only way you're going to lose money is if it turns out to be atrocious. But if it's bad or mediocre, you're going to make a lot of money because you bought it assuming it was going to be horrible. And we think that a lot of this has been very priced in. Secondly, an adage that I'm sure most people have heard: real estate is local. And you look at New York City as an example. Park Avenue rents are 50% higher than Lex, and Lex is 50% higher than Third. So even though rents are going down, you now have a situation where somebody who used to be on Lex says, ooh, I can afford to be on Park now. So what's really happening in real estate is the best real estate is totally fine. The middle real estate is being buffeted to an extent. And the sort of B, C quality buildings are getting really hurt very, very badly. But the sector writ large has this negative connotation on it that you can buy those sort of, A- properties to horrible expectations.
Right. And that's the pricing that you see on some of those securities. And to that end, there's no exchange for, securitized products. There's no ticker. There's no intraday fair value that you can see on the asset class. So talk about how you have the ability to create value for investors, for shareholders, not only through the income component, but also trying to figure out what is the right price to pay for this.
Sure, it's a great point. I mean, it's one of the reasons that this product does belong in people's portfolios, because it's not something you can do at home. Unlike equities, where all the information is free, in our space, virtually all of it costs money. So not only do we have to pay for the data, but we have to hire people that can do things with that data. So that's point one. And then point two is, because it's an over-the-counter market, there are times where the only people that know something is for sale are the 3 people that the bank called. So it's important to have relationships that people call you. It's important to have the investment in data and technology and investing team that you can respond quickly enough to situations that people will call you quicker than other people because they know they're going to get, or that you may give them a fast answer. And we're plenty of times where we've been able to buy things at, we think, are really, really cheap levels because the markets are opaque and not everyone is seeing the flows.
And just give us the flavor of how wide can the spread be, between price A versus price B for the same asset?
Well, there's 2 answers to that. One is the people who are making the markets, and those markets are more narrow than the range of markets, meaning if 2 people are making a 2-point market and one of those people is making the market 78.80 and the other person is making it 58.60, is the market 58.80 or is there a 2-point market? Just depends on which 2 points we're talking about. So markets tend to be much wider than corporates and equities, but if you're an educated investor and you can talk to a lot of counterparties, you can narrow that spread a lot, and sometimes buy things from people at prices that are less than other people are willing to buy them from you.
I'm sure there's a lot of misconceptions about your market. So what would you say are some of the biggest misunderstandings about this?
Yeah, well, one is that it blows up every few years because people know what happened in 2008, and I think it held in the right hands, it does better. 2, that because it's so complicated, it's better to just avoid it, right? There's a saying, invest in what you know. But our product, because we would get into the weeds, we'd have to have an hour or 2-hour interview to get into why we like different bonds and why we don't like other bonds. That's beyond the sort of understanding of most investors. And so you have people who say, I'm only investing in the thing I understand. And so the result of that is our product is chronically under-supported. by investors.
And the fact is, it's been since the global financial crisis that it doesn't actually blow up every couple of years. But in the meantime, it does showcase some economic resilience, and especially in today's market environment where you have strong consumer and this sort of insulated from the interest rate environment economy, that is quite supportive for the asset class.
Yeah, that's right. I agree.
Well, Greg, with that, thank you so much for your perspective, and thank you for breaking down parts of this interesting and fascinating and important securitized product market for us. And I'm taking away from this that investors can be looking to the space for a pretty significant yield opportunity of low double digits. You also have the resilience in various economic environments, and of course, today with a solid consumer backdrop, this is an asset class certainly worth looking at. So, Greg, thanks so much for your time today.
Thank you.
Today in our Spotlight series, we answer your question of the month, and I've invited iCapital Managing Director and Head of Technology Solutions, John Scarpato, to the studio to help us answer your question. John, welcome.
Thank you, Anastasia.
It's great to have you here. And, John, as you head up the technology solutions, I thought this question was perfect for you, which is a common question that we get from all of our clients, which is, how do I actually scale my alternatives business? What do you say to that?
Yeah, it's critical, right? I mean, to state the obvious, using alternatives as part of your practice when recommending alternatives to clients, that can oftentimes be a very difficult task for advisors. Mm-hmm. These are highly complicated products. They require an awful lot of documentation. There are a lot of stakeholders involved in managing the implementation of these investments. The data itself can be difficult to access over time. And so that requires a certain degree of technological sophistication in order to be able to manage all of those processes in ways that are consistent and repeatable and reliable.
Right. So clearly using technology to create this repeatable process, that could be a game changer, and that's the path to scale. So give us a couple of tangible examples of what kind of technology products we have to help scale alternatives within iCapital.
Sure. We think about our operating platform, our technology, in ways that sort of mirror some of the key activities that any advisor is going to have to go through when managing his or her practice. I'll give you a few examples. Mm-hmm. Any advisor has to develop an appropriate amount of expertise in whatever product or strategy they're recommending to their clients. These are highly complicated products, and they do require some investment of time on the part of the advisor to be able to understand how these things are structured, how they're priced, how they're positioned in the marketplace. And so we've got a very robust learning management system in place that allows advisors to consume information in a whole host of different ways. There are thought leadership pieces. There are courses that are constructed either with respect to foundational principles associated with the asset class or with respect to individual products. By the way, it also comes with a fair amount of governance and control on the part of the firm. As you well know, many advisory firms are now growing in size. They're larger organizations. And so making sure that there is some control in place so that when an advisor is recommending something, the leadership of the firm, the management of the firm can be sure that they've done the proper amount of due diligence before recommending something to their clients. That's one bit. I think the second bit, and I know that you've had other folks on this show before that have talked about Architect, which is our portfolio construction tool, what we think is a first of its kind in the alternative space. But think about portfolio construction as another opportunity for advisors to be able to learn about how to recommend these assets and if, when, and how to use them. The more that an advisor engages with Architect, the more consistent that process becomes, the more operationally efficient it becomes, but maybe most importantly, the more familiar they become with it. Third part, I think, really revolves sort of around the implementation of an investment. This is a highly complicated process. It requires a lot of information, a lot of documentation. Our platform will walk the advisor through every step in that process and will proactively reach out to the advisor when there is something that he or she needs to do. There's also a fair amount of work associated with all the things that happen after the initial investment is made. I think a lot of people are under the misconception that once that investment is made, the work is done. Not true. But there are activities like redemptions and transfers and capital calls, all of which need to be managed by the advisor, and our system allows them to do that. The third piece really revolves around delivering a great customer experience. We've had advisors say to us, hey, I'm recommending 3 or 4 different investment products to my client. But after that investment has been made and I need to be able to access information, or more importantly, my client needs to be able to access documentation, they're having to log in to 2 or 3 different investment portals sponsored either by the asset manager or by the service provider. Obviously, it's very difficult to be able to retain all those different credentials, and it's quite difficult to be able to sort of learn all the different user interfaces associated with all these different investment.
Clearly, John, what you just mentioned is all about consistency and repeatability, and that's what over time builds scale. And I like your point about having to log into a lot of different interfaces and having to remember a lot of different passwords. And I read this article a few years ago from Wall Street Journal, I believe, that cited that as a human individual, our brain can only retain something like 28 passwords. Do you know how many passwords we're actually forced to remember as we log into the variety of websites in our lives? The count is in hundreds. And to that end, John, the last question to you is, how do you, as the head of technology solutions, how do you gauge if some of the tech offerings are being successful with advisors?
Yeah, I think the measurement of success, Anastasia, is really tied to how an advisor and his or her client relates to one another and sort of the essence of that relationship, right? Most advisors, they want to spend time with their clients. They want to spend time understanding their needs, their circumstances, their goals, their family dynamics.
Yep.
All of the things that are required in order to deliver a set of investment recommendations are critical for sure. Accessing information, speaking with other service providers, conducting analyses, all mission critical things. But they are things that take time. And so the more we're able to sort of help an advisor get through those mission critical activities, but in a way that allows them to maximize the amount of time that they're actually spending with their clients, that's how we define success.
Right. So technology should be easy. Technology should be an enabler of ease in other parts of their practice. John, thank you so much for helping us answer that question of the month, and thanks so much for joining us.
Thank you, Anastasia.
And we'd like to hear from you. Send us an email to yourquestion@icapitalnetwork.com and let us know what questions are at the forefront for you and your clients. I'm Anastasia Moroso, and thank you for joining us today. We'll see you next time on Beyond 60/40.